If you've been investing in crypto for the past couple of years, you will be well aware of the absolute roller coaster that the crypto market has been on. Bitcoin reached a peak of $61,200 on 12 March 2021, dropped down to a low of $31,500 on 16 July 2021, shot back up to a high of $64,400 on 12 November 2021, and dropped down again to a measly $19,300 that we are currently seeing. Now, in an ideal world, we would want to buy Bitcoin at a low and sell it at a high, thereby pocketing some juicy profits, right? But seeing that none of us has a crystal ball, this is nearly impossible, especially if you want to do this consistently. So instead of having the stress of constantly watching the markets and refreshing your Twitter feed just to see what Elon Musk will post next, I want to introduce you guys to a much better and sustainable strategy of how you can invest into Bitcoin or crypto in general. And I will show you exactly which platform in South Africa to do this so that you can get started straight away. Now, when it comes to long-term investing, whether it is into stocks or crypto, there are basically two different strategies: dollar cost averaging and lump sum investing. Lump sum investing is where you invest large amounts of monies into the market whenever it is available, whereas with dollar cost averaging, you divide the total amount that you want to invest into smaller equal amounts and then invest it regularly into the market, whether it goes up or it goes down. Now, to see which one of these strategies would work best when investing into crypto, we first need to understand how they have played out in the stock market in the past and then compare the fundamental differences between crypto and stocks. Alright, so there are three main arguments for using the lump sum investing approach when it comes to investing in the stock market. Firstly, if we zoom out and look at the past performance of the stock market over several decades, we would see that in the long term, it trends upwards. Yes, it might dip a little during a market correction or market crash in the short term, but it always recovers and moves up again. So if you were to invest your money at random times into the stock market over this long period of time, the odds are well in your favor that you will catch more upward trends than downward ones. And by catching an upward trend, the money you have invested will quickly grow, thereby giving you the maximum potential returns. The second argument for using the lump sum investing approach is because of the different ways that you earn money from stock investments, meaning capital gains, dividends, and interest. By investing lump sums early on, your money will be in the market for longer periods of time, and therefore it will provide more opportunities to increase your investment returns by capitalizing on the dividends that most companies tend to pay out during different periods of the year. And then the third argument is that if we compare the performance of different asset classes, meaning stocks, property, bonds, and cash over the long term, stocks will outperform cash by quite a large margin. So if you keep your money in a bank savings account instead of investing it into the stock market, trying to wait for the perfect opportunity to buy the dip, the value of your money is slowly being eroded by inflation, and thus you are essentially losing out on the potential higher return that the stock market might offer. So it is therefore statistically much more beneficial to put your money into the market as soon as possible to get the highest possible return over the long term. Vanguard, which is one of the most respected investment companies in the world, conducted a large study in 2012 where they tried to settle this argument by looking at which one of these two strategies worked the best in the past. They looked at three different portfolio types consisting of stocks, bonds, and a mixture of stocks and bonds in three different markets: the United States, the United Kingdom, and Australia. And then they ran simulations that spanned close to 100 years. And what they found was that in all of these scenarios, the returns from the lump sum investment strategy beat those from the dollar cost averaging strategy 67% of the time, with an average magnitude of outperformance of around 2%. And the reasons for this outperformance are basically because of the three arguments I just mentioned. So from this data, it is clear that lump sum investing is the winner when it comes to stock market investing, right? Right? Yes, from a pure numbers perspective, it is. But investing is just as much an emotional and psychological process as it is a statistical one. Even though lump sum investing will win 2/3 of the time, you still have a 33% chance of investing your money right before a market crash, which could cause your investment to lose 5, 10, 20 or even 30% of its value within a couple of weeks. And if this was money that was really important to you, like an inheritance, your child's tertiary education, or even your own retirement funds, this will cause a lot of stress and sometimes even a bit of resentment, which might cause you to make irrational decisions like panic selling your investments at a loss only for the markets to recover again, causing you to miss out on that rebound growth. We have experienced 2 market crashes within the past 3 years, where the stock market lost 30% of its value in March 2020, and where we are currently in a market crash with the markets down more than 25% and counting. Seeing the value of your portfolio dropping like this every day is not lekker, and it takes tremendous self-control and discipline to not only not sell off your investments at a loss in fear of losing more of its value, but also to continue investing while the markets are falling. If your risk tolerance is low or you are an inexperienced investor, then no amount of fancy graphs or past data and studies will be enough to convince you to keep your money in the market and invest more during a market crash. And that is why the dollar cost averaging investment method will likely be the best investment strategy for most people. By investing the same amount of money into the market every single week, month or quarter, you basically achieve 5 things. Firstly, and arguably most importantly, you are developing a great habit of constantly saving and investing your money no matter what. This really is the cornerstone upon which true financial freedom is built on. Secondly, as you are investing the same day every single month, you don't have to be bothered by the constant bad news and clickbaity titles that predict all doom and gloom in the markets. You can therefore just focus your energy and time on building your career and family with the knowledge that the market will always recover. This takes emotion out of your investing and prevents you from potentially damaging your portfolio's returns. Thirdly, as you are buying both when the market is up and when it is down, you are evening out your average purchase price, which helps to reduce the volatility in your portfolio and therefore reduces the risk of taking large knocks at a time. Fourthly, as you are not bothered by market crashes, your money remains in the market when it swings back up again, therefore capitalizing on all the positive returns. And fifthly, it is something that can be completely automated so that you don't even have to spend any valuable mental energy thinking about it. All you need to do is figure out your long-term investment strategy and then set up debit orders to go off automatically every single month and be done with it. So to summarize, the main advantage of dollar cost averaging is that it reduces the negative effects of human emotions and psychology, and therefore removes the risk that you may make counterproductive decisions with your investment portfolio out of greed or fear, such as buying when the prices are rising or panic selling when the prices are falling. Okay, so now that we've covered both the strategies in detail within the stock market, we need to try and figure out which one would work best in the crypto market. And in order to do this, we first need to look at how the crypto market is different to that of the stock market. Firstly, seeing that Bitcoin, which is the first ever created crypto coin, was only created and launched in 2009, we have way less data available on how this asset class performed in the past, and therefore it is quite difficult to run the same simulation as Vanguard did to compare the past performance of both these strategies. Secondly, seeing that cryptocurrencies is a relatively new technology that is still in its early adoption phase, its price is extremely volatile and therefore considered way riskier than the second riskiest asset class, aka stocks. Thirdly, cryptocurrencies are still fairly unregulated, therefore preventing mass adoption from institutional investors and limiting the amount of capital that can enter the crypto market. And fourthly, unlike stocks, crypto does not pay out dividends, so the only way of making money from crypto is either by selling it at a profit or by staking it to earn some interest in the form of more crypto coins. So given the differences between crypto and stocks, we can see that lump sum investing is not as favorable when compared to dollar cost averaging because, firstly, there's no real benefit of investing as much crypto as soon as possible, as you won't benefit from dividend payouts as you do with stocks. Secondly, where the stock market might fall up to 30% in the worst case scenario, crypto can easily fall by more than 70%, which is where Bitcoin is currently at when compared to its all-time high in November 2021. So if your risk tolerance is low or you are prone to making erratic emotional decisions, then seeing half the value of your lump sum investment vanish before your eyes within a matter of weeks will not make investment lacquer for you in any way, shape or form. And thirdly, seeing that crypto is still a relatively new investment asset, there are many self-proclaimed crypto gurus or crypto experts that will use social media to promote hype, which can lead naive beginner investors astray by causing them to buy speculative coins due to FOMO and then sell it off at a loss when the coin gets dumped. So I'm sure that you will agree that dollar cost averaging is a much better, sustainable, long-term investment strategy when investing into crypto, as it removes the risk that the volatility of the crypto market brings, whilst encouraging good investment habits by saving and investing regularly into something that you truly believe will eventually become an integral part of our everyday life. And just to give you some real numbers, if we compare investing a lump sum with dollar cost averaging into Bitcoin over a 1, 3 and 5 year period, you can see that you will get a slightly higher return when the markets go up, but also a way lower return when the markets go down when using the lump sum investing approach. So again, the dollar cost averaging method is much safer by taking away a lot of the risks while still producing excellent annual returns, especially when compared to the stock market. Okay, so now that we've established that the dollar cost averaging investment method will work best when investing into the crypto market, we need to figure out how to best do this. And as promised, I will show you exactly how. Now, seeing that crypto is still considered to be a very risky and a volatile asset, most experts recommend to only invest around 5% of your investment portfolio into crypto. And seeing that most of us earn a salary every month, we can already determine how much and how often we want to invest. So in my case, I want to invest 1,000 Rand every single month. Next, we need to decide in which crypto coins we want to invest in. The dollar cost average method will only work with those assets that you believe will continue to grow far into the future. So I would recommend to only use this method to buy coins that have proven themselves to have intrinsic value and who have been around for a decent amount of years, like Bitcoin, Ethereum, Ripple, Cardano, and Solana. The next step is to create a strategy on how we are going to buy these coins every single month. Now, there are two methods in which you can do this. You can either sit down once a month and manually buy each coin individually, or you can use a platform which will allow you to effortlessly set up your purchase strategy to buy these coins automatically every single month without you even needing to think about it. And luckily, the easycrypto.com investment platform, who is also today's sponsor, happens to have an auto buy function where you can set up an auto buy template to purchase over 160 different coins in whatever ratio you want, and then immediately send them to your software wallet automatically every single month or as often as you want. This is ridiculously easy to set up, and I will quickly show you exactly how. First, click on the link down in the description to sign up, and you will receive a free 50 Rand crypto voucher to help kickstart your investment journey. You then need to create an account and verify your identity, which is really quick and easy to do. Then once your account is verified, log in, hover over the buy and sell menu and click on auto buy. Scroll down and click on the get started button. Next, you need to select the types of coins you want to purchase and in what percentage. So in my case, I will just split up my allocation 50-50 between Bitcoin and Ethereum. Next, you need to enter a deposit test amount, which the easycrypto.com platform will then automatically split it into the different ratios that you entered for each coin. If you are done and happy with your allocation, click on add delivery address, where you need to enter the address to the software or hardware wallet where you will store your crypto coins. If you don't yet have a crypto wallet, then I would recommend to open an Exodus software wallet, which is free, simple to use, and which can store and hold up to 245 different crypto coins. You can check out this tutorial from the easycrypto.com team on how exactly to set up an Exodus wallet, and I will leave the link to the video both here in the info cards and down in the description. Right, so after you entered your addresses, click on confirm order, and then the last step is to schedule a payment from your bank. So click on how to pay and use the banking details shown on the screen to create a debit order payment from your bank. Make sure to use the correct reference number and to deposit at least 500 Rand each time, as that is the minimum required amount to set up this function. And voila! Your crypto investment strategy has just been put on autopilot. Now, whenever you make a payment and the payment arrives with your reference number, the easycrypto.com platform will then make the trades on your behalf and then automatically transfer them to your different wallets. Really neat, huh? And if you were wondering what all the fees will be and how it compares with other crypto investment platforms in South Africa, then make sure to go and watch this video where I ran an in-depth study to see how much Bitcoin you will end up getting by depositing 1,000 Rand into 5 of the most popular crypto platforms in South Africa. Thanks for watching, guys. Let me know down in the comments if you guys have any questions. You must all have a lucky day. Cheers.